Welcome to the Weekly Juice Podcast, where we discuss all things real estate, personal finance, investing, entrepreneurship, and the many ways to achieve financial independence. We interview accomplished investors and entrepreneurs with the goal that their stories inspire you to take control of your financial future. Here to get your creative juices flowing, while also documenting their own personal investing journeys, are your hosts, Corey Jacobson and Ryan Bevilacqua.
Welcome back to the Weekly Juice. As always, it's your boys Ryan and Corey here with another episode. Today we interviewed Chris Miles. He is a cash flow expert and also known as the anti-financial advisor.
Yeah.
So he's a leading authority in
financial advisor that turned he was a financial advisor, then he turned into the anti, which is pretty cool.
That's a good story.
Yeah.
There's reason behind that.
Yeah.
So as I was going into, he's basically one of the leading authorities teaching entrepreneurs and professionals how to get their money working for them today. He's used his knowledge not once, but twice to essentially build himself up to be financially free. He had, as many that we've had on the show, had a lot of issues in 2008 when the market
$1 million
crashed.
in debt. He paid it all off. It's crazy.
Yeah, it's wild. And so to build that back up is no easy feat, but he did that. And now he has an educational platform and business where he helps people learn how to free up their liquid cash and to be able to invest that into multiple things, including real estate. And we also we went heavy at the end, not really the end, probably the last 30 of the episode, into infinite banking. And I know we've discussed this before on the show, but Chris really explains it succinctly, and I think answered a lot of questions that are the obvious questions that many people would have. So I kind of peppered him, and he had a good answer for everything. And I've researched it before, and I know what Chris is giving you is actually the correct answer. So
the key takeaway, though, from this is you have all these investments that are not investments. You have vehicles out there that are pushed by banks, that are pushed by Merrill Lynch, that are pushed by Vanguard and Fidelity to invest in a Roth IRA or a 401k. And we've talked about these before. This isn't to say we're shitting on one or the other. It's just that this infinite banking aspect of it gives you more liquid freedom. Like you're able to access this capital way more easily. Whereas for me, I don't have infinite banking. And we talked about it before we started to do the recording, because I'm still trying to piece it all together. Chris does a very good job of doing it. But the point is I have a brokerage where I'd have to sell my stock or, my 401k is just stacking up. And I'm like, it's going to take me forever to have enough money that I actually want to have in here. So the infinite banking aspect is just a way to access that capital quicker. And we mentioned in the episode, nobody that's worth 50, 60, $100 million, 200, 500, $1 billion, whatever your goal is doing that off of 401k. So there is a give and take. And I know in earlier episodes, we talked about 401ks. We're not necessarily saying one is better than the other, but bringing this to light is just interesting because one of the things may spark your brain to go in one or the other direction. Or you might say, no, I love the peace of mind of a 401k.
Yeah, I think the 401k is a tool to kind of sit in the background, and you just got to hope that when you retire that the government's not going to squirrel away more of this than they give back to you, and what the rules and regulations are at that time. So we talked about in the show, at least for me, I'm not all the way in on one and all the way against the other. I think it's good to hedge your bet and have all these little siphons of where you deploy your cash over time, just have them work for you. I'm a big proponent of trying to stack to get to six figures in each of these accounts and then let that compound for you over the years. The faster you get there, it's just the faster it's going to compound because the six figures is obviously bigger than five figures. And so it's just the velocity of money. We have found in every person, probably 90% of the people that we've had on our show, they're investing in real estate, and that's it. The velocity of money and how you can churn that and build it on top of each other and compound over time. We haven't found a better vehicle than real estate. And then within real estate,
fastest way to your money.
Yeah, something like that. But within that, there's a lot of different strategies. And that's why you can go back to the beginning of the show. We've talked long-term rentals, short-term rentals, house hacking, large multifamily syndications. There's hard money lending, private money lending. There's so many things you can do within the sphere of real estate that are allowing you to use the velocity of money quicker than these long-term, what do you want to call them? Like the traditional how to
like
become an
long-term
employee.
vehicles. Yeah, exactly. And this episode is how to access the capital to then go do the real estate that we talk about. So very, very cool. Chris has been doing this for 25 years, so he really knows his stuff.
Yeah. All right. Without further ado, let's bring in Chris.
When you have investment properties and tenants, you need a good system in place for collecting rent to make it easy as possible. And RentRedi can help you with everything. When you sign up for RentRedi, you can start adding your properties, inviting tenants, and creating charges. You can even set up automatic rent reminders and create auto late fees as well. For tenants, they can pay via ACH, card, or even cash using RentRedi's web and mobile apps. They can also use an automatic payment setup and sign up for rent reporting so they get rewarded for paying rent on time. RentRedi saves you time and hassle by automating rent collection, and you can manage everything from one dashboard. For our Weekly Juice listeners, RentRedi's given us a special 50% off for any RentRedi plan using our code WeeklyJuice at rentredi.com. That's RentRedi.com using the code WeeklyJuice. That's WeeklyJuice to save 50% off any RentRedi plan.
Chris, officially welcome to the Weekly Juice podcast. Corey and I are so excited to have you on the show, man, to showcase your story and hopefully drop some bombs on our listeners on how to become financially free.
I know. I'm excited for the steroids, man. Like that's exactly why I came for the show for. That's the kind of juice you're talking about, right?
That is the juice. Yeah, probably like the pack a punch for your Wednesday, man.
That's right. Lance Armstrong just was on, just barely, wasn't he?
Yeah, he was. He was barely.
Yeah.
So, Chris, let's start here. Take us through. Well, first of all, for those who don't know, you are known as the anti-financial advisor. So, I want to kind of go to your background and kind of how you got into real estate investing, and then maybe take us through infinite banking and how you built your streams of passive incomes to make yourself financially free, not once, but twice. I know there's a lot of story to unpack there, but maybe take us to the beginning and catch us up to today.
You bet. Yeah. So when it came to like investing and money, I knew nothing, right? I mean, my parents, they taught me to work hard. Your word is your bond, be honest, that kind of thing. But when it came to money, it was usually about how we don't have enough of it. I don't know if you were raised that way too, where they say things, hey, we can't afford this. Money doesn't grow on trees. What do you think I am, made of money? All that kind of crap you'd hear growing up. So naturally, I wanted to be somebody different. I didn't want to have that kind of worry growing up. So I wanted freedom of my time and my money and really time of my own destiny. I wanted that control. And so I went to college. And it wasn't long after I went to college, I realized, okay, most people are going to college, they're just going to go follow the same employee path. And so I wanted to do something different. I was going to become a business consultant at one point, but I figured if I'm going to do that, I should have real life business experience. So I actually took was supposed to be a sabbatical from college with one class to go before I got my bachelor's. And I was going out. I was like, I'll take a year off. Let's find some business to start and do, get some experience, and then I'll go back and get my MBA. Well, the first business that came up that was intriguing to me was a financial advisor, because I thought, worst case, maybe I'll learn about money a little bit more than I had. Because the only thing my dad taught me was be cheap and, spend nothing, save everything, and, hopefully you'll have something someday, right? Which is basically like Dave Ramsey. He was like Dave Ramsey's older brother, teaching that kind of fun advice. So anyways, so I started being a financial advisor, realized they teach the same thing, just be cheap and save everything in their crap. And then hopefully someday you'll have something, And so I did that for 4 years, loved being my own boss, never went back to college. So I stayed dropped out. So I'm officially a college dropout. And then after 4 years, my dad reached out to me and said, Chris, when are you going to sit down with me and help me with my retirement plan? Which shocked me because he was the kind of guy that never wanted you to know about his money, right? He was always afraid people were trying to rip him off. Well, I sit down with him at the same kitchen table. He told me taught me all my money lessons about being cheap and saving a lot of money, right? And I'm sitting at that same kitchen table and he says, all right, Chris, I'm 61 years old. I want to retire today. What do I do? Well, he paid off his house, 18 years. He was super proud. He was debt free. He had saved money into his 401k for decades, got the match and everything. And I looked at everything. I said, Dad, here's the deal. If you want to retire today, you better hope you die in 5 years, because that's when you're going to run out of money. He said, all right, well, that's not what I wanted to hear. What do I do? I said, I don't know. I can throw you into this stock program or that one, but if the market tanks, you're going to hate me and maybe disown me. So let's not do that. I said, I don't know. I honestly don't have a good answer for you. I'm like, you got your house paid off free and clear, but you can't do anything with that. I wouldn't put that in the stock market. And so I was lost. And it was, of course, when the student's ready, the teacher appears. A few weeks later, I'm talking to a friend of mine who I trained to be a financial advisor. I trained him to do that, but then he left to go do something crazy called real estate investing. And so I was calling him up thinking, oh, he's probably broke. He's probably not making any money in real estate. He needs to come back and work for me. I get the opposite reaction. He says, Chris, man, life is awesome. My dad and I have partnered on some deals, and already with some of the flips we've done, we've doubled my dad's income as a professor at the local university. I said, oh, come on. You've only been doing it for 4 months. That's too good to be true. There's no way you can make that much money in real estate. And he finally just stopped me. He said, Chris, how many of your clients are truly financially free where they don't worry about money, like running out of money? I said, well, none of them. They all worry about running out of money, even the retired ones. Okay, Chris, that's awesome. How about this? How many of you guys as financial advisors are financially free, not off the commissions you're earning, but actually doing these mutual fund investments you've been recommending? And as I was really honest with myself, and there was over 100 guys in our office, I said, none. I mean, there's guys been working here since the really late 1970s, and they still can't retire. He said, well, isn't that a clue for you, Chris? And I said, and so at that point, I could either let my ego get in the way and say, screw you, like stocks are better, real estate sucks, or I actually listen. And so I chose the latter. And in fact, he actually didn't believe me. He actually thought I would argue it. And then I finally just said, well, give me something. And so there was a radio show at the time, AM radio, talk radio, where these two real estate investors were doing stuff like a podcast. They were talking about stuff. And I started listening to that, and I got brainwashed essentially in a good way, realizing that what I was teaching as a financial advisor wasn't going to work. And of course, I had to make a choice. Either I stick with it or I leave. And so I chose the latter. I said, I got to keep my integrity intact. I can't just do this for the money. I got to get out. And so I vowed never to teach about money again, which is why I'm here, of course. But I vowed never to teach about money again. I would just be a mortgage broker and teach ballroom dancing on the side. And that was pretty much my plan for 2006. Well, I also want to know how these guys did it, because there's guys in their 20s and 30s, making bank, like making hand over fist money in real estate. And so I wanted to get a part of that too, start to learn from them a little bit. And the next thing you know, later that next year, I was able to retire myself. Granted, I only had 1.5 kids, 2 kids at the time, so I only need like $3,500 a month to live at the time. But, now I've got 8 kids. I need at least $10,000 a month. So, yeah, 8. Just in all fairness, 2 of them were my wife from a previous marriage. So they weren't all mine. Only 6 were mine, So, my dad's still asking me if I know how it works. But, he still wants to give me the birds and the bees talk at this point when I'm 46 years old. But got
your hands.
So anyways, so naturally, like any 28-year-old who's all of a sudden now retired, people want to know how the heck I did it, right? And so 2007, I actually came out of retirement to teach people how I did, how I was able to retire, how to create enough passive income where you're work optional. You work because you want to, not because you have to.
Got it. So the interesting thing here, Chris, is that most people tie themselves to an ideology and never let go. And you can see that in politics, right? Like what's happening in the political sphere. Not to talk about that, but it reminds me of the same thing. You, on the other hand, you were a financial advisor, and most people double down and be like, my way is the better way. This is how you do it. And I find it very interesting that you were able to just change your mentality. I think that's a strength, that you're able to change your mentality. Can you talk about that process of going from, well, I've done this for so long, and then realizing what you've done isn't working anymore for you, and the pivot? I'd love to know about the pivot.
Yeah, I mean, I am stubborn sometimes. Like sometimes it takes a little time to get through my thick skull, to adopt stuff. And it was definitely harder because literally my bank account was relying upon teaching what I taught as a financial advisor, right? But when you come back to the why, like why did I get into it in the first place, was 1, I wanted to figure out how to have financial freedom for myself, and 2, how do I give it for my dad? And if I can't see the light with those 2 situations, which kind of happened because I realized I was on the same path as my dad. I was trying to live cheap, save everything in mutual funds. I thought my dream was, be cheap enough, turn off the heat in the wintertime, turn off the AC in the summer so that my wife and kids are miserable. And if I scrimp together enough money and throw it in the stock market, hopefully earning whatever percent they claim you make, which is not 12%, by the way. I learned that later on as a financial advisor, when I realized it was a lot harder path to get to that $2 million to live on 3%, which is $60,000 a year, right? $5,000 a month. I used to think was the dream. I realized like, man, that's a horrible life to have to hope and pray I can get to that point. Where in real estate, for example, I mean, if we just use simple numbers, if you earn 1% a month, well, if you want that same 5,000 a month, you just need $500,000, not $2 million. You can have a quarter of the money just working harder. Not to mention the fact that it's a lot less risky than being in the stock market, right? Because if you have real assets, and I'm not talking about like doing different derivatives and things like that, but if you have real assets, tangible real estate, that's something that's real. That's why it's called real estate, not, Tesla or Nvidia or whatever other, Facebook or anything else you're trying to buy that could tank the next day because, Elon Musk tweeted something weird, or Biden decided to say something stupid in front of everybody and the market crashes, right? Like we can't control that, but we can control what we do. And so it was hard to do that. But again, I like to be right. That's the good and the bad. I like to be right. So sometimes I have to admit that I'm wrong in order to be right.
I like that. Thanks for sharing. So let's get down to nitty gritty. Let's get into the how. I think that's what a lot of people are, they listen to our show for. They're like, okay, there's the ideologies are great, but how did you actually do it? And you did it twice. So as you walk us through this, can you talk to, the multiple income streams you've built, just kind of how you have your full steam of things kind of flowing together?
Yeah, the first time was kind of accidental and intentional all at the same time, a little bit. Granted, 2006, I mean, if you remember, the real estate market back then was pretty awesome, right? It was kind of like 2021, it was pretty amazing. It probably a lot worse than 2021, actually. It was a lot. I mean, getting a mortgage, for example, you could get 0 down mortgages back in those days, it was so easy to make money. And that's part of what led to the downfall too. So the big thing I realized was it wasn't about, again, letting my money accumulate and squirrel it away, like a bunch of nuts. Instead, it was about how do I get it to produce income? So I remember one of the first things I learned was about being a hard money lender. I never even heard of that phrase before. Again, financial advisor for 4 years, never heard of any of this stuff. And so a hard money lender where you can get paid. Now back then, some of those guys were paying like 2%, 3% a month, so it was pretty ridiculous. It made it a lot easier to hit your numbers a lot faster, but it was still the money was being made so easily in real estate, they could afford to do it. So hard money lending was part of it. I had rentals too. I remember I took my starter home, sold it to an investor at full appraisal, and then turned around and leased it back to then sublease it to a renter, if that makes sense, right? So I basically, sold my property to an investor and then leased it back so I could sublease it and try to make rent off that. It wasn't exactly a huge cash flow play, but it got equity out of my property, still had a nice rental. They gave me some write-offs and I could still invest that money elsewhere, So things like that is what I did. And here's another one I talked about a little bit accidental. I remember one of the guys that was kind of mentoring me at the time, he was teaching me a lot of this stuff. And he asked me, he said, Chris, I know you're doing mortgages right now. Do you like doing mortgages? Like if money were no issue, would you keep doing it? And I said, well, I hate paperwork. I love teaching people, but I absolutely despise doing paperwork, right? Like I that's the one thing I definitely do not want to do if money were no issue.
The consumer hates the paperwork too, by the way, on the mortgage process. We hate the paperwork. So it's so funny that you're in the same boat. Go ahead.
Oh yeah. I just despised it, and I hated the fact that I would tell somebody, hey, it's going to take me about 3 weeks for this process to go through before you'll realize if you get approved or not. And then the next day they call me, am I approved? Right. So I hated that. I hated feeling like I was trapped to my phone and trapped to paper. So he said, well, find somebody who can do that. And I said, well, there's nobody that likes doing paperwork, is there? He says, trust me, there's nerds out there that like it. So I went to my broker, the broker that I was working with. I said, hey, who do you know that actually likes to do this kind of job? They said, oh, Clark does. Because anybody with the name Clark would definitely like paperwork, right? Because you got to be a nerd if you have that name. So I go to Clark. I say, Clark, listen, if I basically spoon feed you clients that are already ready to do something, I'm already teaching about cashing out the equity to then invest in real estate. I'm like, if they're already ready to go, would you do all the work for me? And he said, yeah. I'm like, great. Would you split it 50-50? Well, of course. I said, awesome. And so I would, talk to somebody for a half an hour, teach them about like how you can use the equity to then essentially pay for your mortgage payment for you. They're like, awesome. Well, how do I get this mortgage done? Talk to Clark. And so I had the license, so it was still legal. Send them on to Clark, pass them along, and voila, I get a check for like $1,000 or $2,000. And I thought, my goodness, that's so easy. So while I'm also getting real estate income, I'm also getting this other income. And I started doing this with a few other businesses that I realized that I was already sending referrals to, right? So it's kind of like before affiliate marketing became affiliate marketing, got all prostituted, so to speak. It was really just people that asked me common questions. I was like, man, people keep asking for this. Who do I know that I can send them to that's a good business owner? And maybe they have a marketing budget that will pay me a referral fee or something. As long as it's legal.
It's truly the who, not how model, right? Like,
yeah, it really is.
Found somebody that it's hard to think that. And Ryan and I are going through this a little bit right now. We're not a new business, but a new facet of real estate. We started the creative financing space, and we're like doing cold calls. And Ryan and I are really good at sales. Well, I mean, yeah, we're
relatively speaking.
Yeah, maybe not. We're not. What's the guy, Andy Ellie?
No, dude,
beat us up, man.
He would beat us up.
But I just think we're good at sales. But our time is probably not best spent doing cold calls. And we're like, we got to get someone to do this. We leveraged the relationship we had with someone. We met with their team, and we haven't really we're just kicking it off now. But I can already tell these dudes are rock stars. Like they're gonna crush it. So finding that who. You have to pay the who, right? Or exchange for some other good service, and they can do the how. So I love that that's model. Right. I think there's training that it's involved too, but that's the beauty of it, is that you don't have to do everything. So I love it.
Yeah. And to be fair, I did zero marketing too. So it was purely just friends and family, just very casually doing that kind of those connections. Right. And, that was what's cool. Between that and the real estate, everything I was doing, I was making $4,000 or $5,000 a month. Anything I made actively was just gravy on top. It was just more money to invest.
So were you doing flips at this time too? Or is it just basically like buy and hold investing? And on the real estate side, I'm trying to just conceptualize outside of the mortgage game. Okay.
I was doing a little bit of flips as well, until 2007. Yeah. And that's when I went from, pretty much the place of where I was free to broke, right? I actually went over $1 million in debt, primarily because here's the crazy thing is that we started a business, where I was teaching people how to get out of the rat race. I started with another few partners as well. And we were focusing only on flippers, like real estate flippers. That was our whole market. Well, July of 2007, I remember I was trying to do a cash out refinance and I couldn't do it because the bank said, oh, we just changed the rules last week. Come back to us next month. Get your score up 2 more points. So I get my score up over 2 points. In August of 2007, I go to them. They say, oh, you know what? We just changed the rules again. Come back to us next month. As long as you keep your score up and you do these things, we'll give you the loan in September. September rolls around and they say, sorry, we no longer give out loans to business owners or real estate investors. And I had all this equity trapped in my property because I just thought, I was a mortgage broker. I thought I could just throw this equity in my property, get it out whenever I would need it, right? That wasn't the case anymore. Now it was trapped. And then I had to slowly, helplessly watch it disappear as the markets were tanking because the banks just froze everything. And so real estate flippers, they couldn't pay us because they weren't making money. I wasn't making money on the real estate side anymore. I had some the property I subleased. I was trying to figure out how to get out from under that. I was fortunate to sell it for what I owed, barely. But I mean, I was in a world of hurt. And between the business expenses and my personal expenses, I was in the hole like $15,000 a month. So, I mean, it was, even though the flipping worked great in 2006 and even into the first part of 2007, definitely by the third and fourth quarter of 2007, it's like somebody just stuck a stick in bicycle spokes and you flip over the handlebars. It was just like that. It was like a train wreck, and so we were all just suffering. And
so Chris, how did you not file bankruptcy? Like, how did you get out of that situation? $15,000 a month in the red doesn't sound like an easy scenario to pull yourself out of.
Just because I'm stubborn. It would actually have been smarter in some ways to go bankrupt because at least I could hit the reset button and not have to pay back the debt. But I was just like, you know what? Like, I know that everything happens for a reason. I believe in God. I believe that everything has a higher purpose. I didn't know what it was, but I remember thinking, especially when I was praying my guts out, I was like, man, if I can even help one person with whatever crap I'm going through, maybe that's worth it. And so I refused to go bankrupt. I just felt like I shouldn't. And so I got lean and mean for one. So I cut back my expenses to nothing. 2009, I eventually had to foreclose on my house. They eventually took it. So I had to I basically sold off all my assets I had, everything. I even turned in my Mercedes. I had got a nice little Mercedes. I turned it into the dealership. I said, you're going to take it from me in a month anyways. Just take it now. And turned it into them. And then they auctioned off for $30,000 less than what I owed. So then the collector's calling me up, and I had collector calls coming in multiple times a day. I mean, the collector calls on the Mercedes said, hey, you owe us $30,000. Can we work out a payment plan of $1,200 a month? I was like, do you realize that my payment was $1,100 a month? If I could pay $1,100 a month, I would have kept it. You wouldn't be calling me right now. And I remember he told me, he's like, you know what? It's people like you is the reason why our economy is crashing right now. It's your fault. I was like, you know what? I hired people just like you, paid out hundreds of thousands of dollars out of my own pocket to employ little jerks like you. Shut up. Like go away. And I hung up on him. I was so pissed. But I was kind of pissed because I did feel like a fraud, right? I felt like a failure. Not to mention, I was the guy that was supposed to have it all figured out. I was the one teaching people how to get out of the rat race, and now I'm back in it. And so here's how I got out. Besides having a lot of faith and literally running on fumes of faith and losing everything almost. Other than the minivan that we had a minivan that we kept for the family, just locked it in the garage so nobody could repossess it, and try to find ways to make payments and do what we could. But we downsized a lot. I started tracking my money very carefully. I got my expenses down to like $4,000 a month. Like I got down dirt cheap with, at that time, 5 kids, and just try to live as low as we possibly could, and about $4,000 or $5,000 a month, and then try to rebuild from there. And so I stopped teaching people how to get out of the rat race. Instead, I started teaching what I was doing. Because again, I can't teach something I don't do myself. I don't practice. So instead of the rat race, I started focusing on how to find money, how to get resourceful, because that's what I was doing. Even like creative ways to pay off debt and things like that. So I started doing that. In fact, because a lot of people would come, they say, I wish I could pay you, but recession's been hard. I don't have the money to pay you. I said, well, if I can help you find the money, will you pay me? And they said, yes. I wouldn't tell them I was broke. I wouldn't tell them that their situation was so much better than mine that I thought their situation looked awesome, even if they were paycheck to paycheck. I wasn't even there. So I would just find the money. I would get creative, whether it's like how to reduce expenses, how to pay off debt creatively, ways to save on taxes, especially if they're a business owner or whatnot, just all kinds of different strategies just to free up cash. And that created a business of its own that pulled our company almost out of bankruptcy into and we went from making $400,000 a year, I think in 2009, to making like $5 million a year in 2010. So it really pivoted. We had to pivot ourselves so that we could pivot the business and turn things around. And
just
so
goes to show the lesson that you learned was, your ability to execute trumped the failure that you had. If you've been there to a place of whatever you call it, success, falling down, you're able to get back up again, actually, because the lessons. So it's very interesting that you're able to pull yourself out of that. Because if you had gone bankrupt without, or not bankrupt, but if you have lost all your money without really hitting a level of success, you might not have been able to pull yourself out. So I find that remarkable, really.
Well, I remember thinking there were no accidents, right? And for example, I was thinking that there's got to be a reason. There's got to be higher purpose. And even Napoleon Hill talks about in Think and Grow Rich is that with every adversity, it's a seed to an equal or greater opportunity. So I thought, man, when it got bad, it was like Rocky III. Remember Sylvester Stallone's getting beat up by Clubber Lang, right? And he's getting pummeled. And they're like, he's getting killed out there. He's like, no, he's getting angry. He's like, then it's so bad. That's kind of what I was doing. I was just like, man, today sucked. I can't imagine how much greater or equal to it's going to be on the other end of this, right?
Yep.
I had to really choose an attitude. And by the way, even my wife at that time, now ex-wife, she was talking about moving out with the kids into her sister's basement until I figured out my crap, So, there's a lot of stuff going on emotionally that hurt, but it really came down to this one key principle. You might have heard Warren Buffett say something similar, which is, stop asking, how do I make more money? And start asking, how do I create value and solve problems for people where money is just the natural byproduct? How can I go about creating value for people? That's true in investing. It's true in business and everything. It's how do I create value for people? Because that is a real secret to money. That's how I was able to dig out, because I started asking, what do people need? What are they asking for? Well, people weren't even talking about getting out of the rat race anymore. They just wanted to be able to get beyond paycheck to paycheck. So I started doing that, because I was already doing it myself. My mess became my message, and that helped pull me out. And then I started teaching people how to do passive income when I started doing more passive income stuff in 2015. And so I started teaching more and bringing that back into the whole freeing up cash thing and then saying, now we can start bringing in passive income. And now we can really get people out of the rat race. And that's what I've been coaching people to do ever since, for that very reason.
So can you talk about that? Can you give us, I don't know, however many actionable steps you have for people to build passive income? I think a lot of our listeners are at that point where they're like, they're quote unquote stuck in the rat race, and they know they want something more. They want their time freedom back. They want financial freedom. And, there's a lot of things that everybody wants, and it takes a lot of steps along the way to get there. But talk to us about building that passive income and kind of having lucrative streams for yourself, that it's just not, you don't have to live paycheck to paycheck or wait for that check every single month just to feel like you can sustain your life.
Yeah. I would say if I were to sum up everything into one statement, it's get your money out of prison, right? The one thing that's interesting about financial advisors, they tell you to put your money in prison, lock it away. And they learn that from financial institutions and banks that they work for. If you understand that almost all financial education, I know you guys are big on this on your show too, all financial education out there is taught to you by banks and financial institutions like Fidelity, Merrill Lynch, and all those companies. They teach you how to become slaves to them, not the other way around. Because think about it. They tell you that you're supposed to pay off your house like my dad did, which didn't work. And then pay off all your loans so that they have control of the money, not you. And then they tell you also to then stuff all the money in with them. Don't touch it, lock it away, set it and forget it, as they always say, right? You're in it for the long haul. Even if the market goes down, just stay in another decade and hopefully you might have your money back again. They tell you all this crap to just lock your money away so that they make guaranteed returns off your money. And so the big key thing is get your money out of prison. One is, make sure you are tracking your money. Make sure you are a wise steward with the money you have. Don't live on rice and beans like Dave Ramsey says, because you're going to drive yourself nuts and you're never going to be free. Listen to his advice either. But actually go and be wise with your money, spend money on the things that are actually worthwhile while eliminating costs on things that aren't. While also doing that, keep your money out of prison, meaning don't throw extra money onto your house. Don't throw that money in that 401k or the IRA where it's going to get locked away till you're 60 plus years old, depending on whatever age the government decides at that time. You're going to have to follow their rules because they're really in control, not you. Get your money in your own possession, right? Even if it's a simple savings account, get it in your savings so then you've got money to deploy. I guarantee you, like a lot of my friends that are in like mastermind groups I'm a part of, if they're flippers, real estate investors, like wholesalers, whatever it might be, many of them, I know if they could go back in a time machine would say, I wish I was more liquid. I wish I had more money in my possession that I didn't just throw back in my company and try to get it all out there because money can't sit around because I'll lose to inflation. When I heard people saying that in 2022, that's when I started putting my money in liquid places. Whether it's my savings account, whether it's my infinite banking accounts, or whatever it might be, I was keeping money liquid. So then I can not only have it there, but then I can eventually get it out to work for me and create passive income.
Chris, I have this battle all the time about the 401k and the like the IRA and the brokerage, because Ryan and I use those tools as a bucket, like just one of the buckets that we invest in. But I go back and forth all the time, and I've done this several times. When my brokerage gets to a certain amount, I've done it twice now. I've sold it and bought real estate. And I'm thinking, why am I'm betting on the market going up to do that. This time I thought I'm going to let it ride for whatever. Mm-hmm. But then I'm like, it's almost like I feel like it's a waste. My 401k, Rye has a 401k that's stacked way higher than mine. It makes sense for him to ride it out. But for me, it's like maybe it might make more sense for it to be liquid because I've made smart investments in real estate. I find that such an interesting topic of discussion because mainstream media will tell you one thing, but if you look at the wealthiest people that you want to emulate, they're not talking about 401ks. They don't have
That's
them,
right.
Right? I'm not talking about Elon Musk and Warren Buffett. That might be a little bit unattainable, but if you know somebody worth $50, $60 million, they still don't have 401ks. Mm-hmm. So it's really interesting because it is for the security and the peace of mind. And that's probably what we use it for. But is it really the solution that you should go for, right? I mean, it depends who you are as a person, right? That's kind of what it comes down to.
Well, you have to be able to to parlay off that. It is peace of mind. I'm glad you brought that up. Yeah. It's just like a nice comfort to have that. Even if you're siphoning off just a little bit of your discretionary income into that, it's fine as long as you have 4 different buckets. Like for me, I have the 401k, I I have the brokerage, I have the IRA, and then obviously we have real estate, we have infinite banking, or I do. So there's so many different buckets, right? I don't limit myself to one thing and put all my eggs in one basket, because one's bound to work. I like to hedge my bet a little bit. But we're talking about all these things, right? And you're saying like, let's get liquid so you can deploy in other things. Let's talk about what those other things are. Like, how can people actually build the income streams for themselves? Like what ideas do you have, or what have you done for them to, when they have the cash, like what the hell do they do with it? And then maybe you can take us into, I know this is completely sidetracked, but I want to talk about infinite banking before we wrap up.
For sure. Well, let's address the 401k, right? I mean, because the biggest argument you get in favor of 401k is the match. Now, if you're a business owner and you're paying your own match, then there's no advantage, right? In fact, 401ks are more expensive than just setting up a normal IRA. That being said, it seems kind of lame that you put money in there. Like you said, you want to have money to get to, but the truth is that they don't want you to get to it, and they will slap your hand. It's like being a teenager, buying your own car with your own money, but then still having to ask your parents for permission to drive the car, right? That's what it's like. He's like, you try to ask for the keys, and you try to pull money out of 401k or an IRA, and you're not 60 years old, you're going to get slapped with 10% penalty, and then you get taxed on it, right? It's so dumb. And then even if you have to try to avoid that, I have to borrow it, but I have to pay it back. And they will make you pay it back a certain percentage every single month. Even if your cash flow is tight, you have to pay it back, or they will then penalize you again, right? So it's kind of a lame type of situation to be in. And again, success leaves clues, as you hear Tony Robbins says, right? I said earlier that I like to know that things work. I like to base things on evidence. Well, let's look at the evidence. Fidelity, which is the largest 401k provider out there. Fidelity has 45 million clients. Guess how many of them have at least $1 million between the 401ks and the IRAs? 750,000. That's 1.5% of people have at least $1 million. And remember, in the financial advisor world, you're, at least with the updated numbers, not the people that teach old junk that's been already debunked, but in the new world, they'll say you should only pull out 3% a year so you don't run out of money too soon. If you're trying to do it like the whole FIRE movement, you're like under the age of 40 trying to do it, it should be 2%. It's even worse. But 3% if you're at retirement age. Well, think about it. 3% of $1 million is $30,000 a year. You're a broke millionaire, right? You're living at poverty line as a millionaire with that money. And this is why those same people, of those people that the 1.5% that actually had $1 million, 35% of them in a Transamerica interview last year said that they think it'll, quote, take a miracle to be able to retire. So these are people, they're the top 1.5%, and still a third of them think it'll take a miracle. That means less than 1% think they're actually safe. Less than 1%. That's like going to Google, looking up a restaurant you want to go eat at, seeing 99 one-star reviews, but the 1 5-star review, you say, oh yeah, that sounds good, right? That's what you're doing with freaking financial advising and 401ks. And here's the reason why 401ks are failing. The reason is simply this. They say about 87% of millennials are actually putting their money in these target date funds inside Fidelity, right? Where they say target date fund 2055, or 2040 or whatever it might be. Well, I went and looked at the historicals on that, because I'm a nerd like that. So I look at the historicals on that fund. While the stock market, it actually underperformed the stock market by over 2%. So it did 2% worse than the stock market before the 0.75% fees came out. So that means it did about 3% worse. Well, guess what that 3% means? Even if you get a 100% match over the long haul, it only makes up about 2 or 3% extra return. It doesn't give you 100% return. It gives you 2 or 3% of a compounded return. So what that means is you basically just the match only made up for the bad performance of that 401k. You've been better off not having it in the first place, right? So the whole match thing that I get from my employer is bullcrap, right? This is why, again, only 1.5% of people have over $1 million today, yet still a third of those people think they'll never be able to retire. That's the big reason. So what you do instead, that's why I say, like, heck, you can put in a savings account, but then you can deploy it, right? Give you an example. One of my clients, Dan, like he actually heard me on another podcast, and he had $1 million in his retirement account with the government. So he said, he went to his financial advisor. The financial advisor said, yeah, you could pull out $30,000 a year. He said, I live in California. No one can live on $30,000 a year. Like homeless people live on $30,000 a year, right? So he's like, no, I can't do that. So he came to us, and then we started looking at things like, he bought a couple of duplexes that, again, he got a property manager for, so he wasn't managing it. He got in some apartment syndications and whatnot. He got in some oil and gas, where he gets mineral rights from that syndication and so forth. When all was said and done, that $1 million is now paying him somewhere between 100 and 130,000 a year. Not 30,000, but 100 to 130,000. That is the difference right there. That's why you don't want your money in those places. Not to mention now, because a lot of that money was IRA money, he still has to pay taxes, even though some of them give him tax benefits. He loses it because he kept it in the IRA. So the best place you can do is have it in a cash-like place. So that comes to your question, right? Which is, hey, we want to talk about where do you keep it? Well, savings could be one place, but you're not going to make, you make 0.0% in your bank. So the place that I keep the bulk of my cash is in places like infinite banking, which is a life insurance policy, right? Whole life insurance, the most boring thing you ever get, but is guaranteed to make at least 3 or 4% a year. But they're currently paying almost 6% a year right now. And that's tax-free. So it's like a Roth IRA, but you don't have all the stupid rules and limits, right? Because a Roth IRA, even though that's kind of cool, it could be tax-free income. The problem is they only let you put in so much per year. It's not enough to ever become financially free, right? So unless you make this sick amount, like if you're doing creative financing stuff, if note investing, maybe you can pull it off. But normally most people never make enough in their Roth IRAs. But here I can put in however much I want. Like I had one guy who was a syndicator. He's like, well, my tax return says I make $25,000 a year, but that's because I write off so much in real estate. I was like, well, how much do you really make before all these write-offs? About $1 million a year. Cool. We're going to tell the insurance company you make $1 million a year because that's what you make. So he did. He's now can put in $250,000 a year into his life insurance policy that then he turns around. And this is the best part. Because again, you don't want to just get any infinite banking policy. There's a lot of crappy ones out there. Most people you hear online suck at this. Okay. This is one of the reasons why we kind of came out to fire away at them, because they just aren't doing well for, especially those who are business owners or real estate investors. But the problem is the cool thing is he's now putting away $250,000, but he's also using this money to invest in real estate. So he's actually making money in two places at the same time, because while he's earning interest, tax-free dividends on this money, he's also able to get this cheap line of credit against it to then go and use that money to invest in his deals to then create a return over here. So he's making a return over here and a return over here. Usually, even somebody who's doing it passively, like a lot of our clients, even if they make only 10% a year, they can usually make at least 11 or 12% a year using this strategy versus just using their savings account. So it's kind of a cool way to keep liquid. Not to mention, most states you're 100% protected from lawsuits and creditors, where you do not get that benefit in almost any place you keep your money, including a savings account or some retirement accounts too. On top of that, like I said, I got that leverage. I get that line of credit that I don't have to have a good credit score for. I can have a crappy credit score, still get it. It's private, and I can pay back that loan whenever I want. So if I'm a flipper, if I'm somebody who's going to work on a property, it's going to take me 6 to 12 months to turn around and sell it. I don't have to make payments to it like I would for a home equity line of credit, where I have to make monthly payments to it. I don't have to worry about that with the life insurance loan. I can use it for whatever I want. I can gamble it in Vegas if I want. They don't care, because they know the money's guaranteed. You're never going to lose money in that thing.
Okay, this is interesting.
Take it from the top.
We should liquidate our 401ks. No, but I'm curious, what is the stigma then? What is the negativity that you hear about infinite banking? Why is it taboo? Why do people not understand it? Why are there all the quote unquote gurus that suck at it, so to speak?
Well, one, you get guys like Dave Ramsey that say infinite banking is horrible. Don't do it. It's a waste of money. Buy term, invest the difference, right? And for the most part, he's right. Most of the stuff I see out there today, and I've been life insurance licensed for the last 22 years, right? Most of and by the way, I never even heard of infinite banking until I became a real estate investor, back in 2006. First time I ever heard about it. Never heard about it as a financial advisor. But here's the problem. I remember I bought my policy from another guy. Even though I had an insurance license, I bought it from him because he knew what he was doing. I didn't know anything about whole life. I was told that they sucked by other financial advisors, not by, anything I learned from my own experience. Well, I remember asking him, I said, listen, this thing's really expensive up front because they're front loaded costs. Term insurance gets a lot more expensive over time. Whole life gets cheaper over time. That's the good and the bad. It's more expensive up front, but it's cheaper over the long haul. But I was like, man, all of my money is going to paying your insurance costs in the first couple of years. He said, well, that's what they all are like. I said, okay, well, I'll take your word for it. Well, 2008, remember I'm broke. I can't keep paying over $1,000 a month in this thing. I paid 25 grand up to that point, and I couldn't keep paying the premiums. I lost everything because there was no money in it. There was no cash. because I paid for a death benefit, but it was like a freaking expensive death benefit. I had no cash in there. Well, I remember I asked him point blank. I was like, can I like get more cash in faster? He said, no, you can't. You get taxed if you do. He lied. I actually confronted him about a few months later, showed him numbers. I ran my own numbers because I had an insurance license. I started running my own numbers. I was beating all of his numbers. I had more cash. I actually had cash from day one in these policies. I said, hey, if I would have had cash from day one, I would never have lost all this money. And finally, after shooting down all of his objections, he just said, Chris, I did it that way because I couldn't afford to cut my commissions. I was like, there's the truth. And that's the reason why I'll never send you a referral again. By the way, he's now since left that business. But even today, there are popular infinite bankers, even on YouTube and stuff like that, that do a good job, but not a great job because of that same reason. They'll say, well, I'll do okay. I'll give them a little bit of cash in day one, but you know what? We're going to get paid too. And so they'll raise the cost on the policy, even though some of them even know how to make it cheaper, they won't. And that is the reason that I got so pissed off. One guy's popular on YouTube about infinite banking. He's been on a lot of real estate podcasts. I remember he was personal friends with one of my friends that was an investor. Well, that guy sent his brother as a referral to them. And I remember the guy was super pumped. He's like, yeah, I'm so excited. We're going to have a real infinite banking policy. I even got like 70% of my money in the first year. I said, do you know that you're already overpaying $1,000 a year than you should be? $1,000 a year more than you should? He's like, I am? He's like, no, I'm pretty sure this guy does. He's awesome. I know the guy is awesome. Like he's a cool guy. He's a guy I would like to model my branding after too. But I'm telling you, the people he referred you to suck. Well, we found out he did. He was overpaying $1,000 a year, not because it'd be any better for him, even though they were trying to make that claim. It was purely because they made $1,000 more in commissions. That's why.
Wow.
And so that's why we kind of made it our goal to be at that max ROI on that cash, because that cash is the thing you can actually use to get that double dip effect, right? Where you can get paid in two places at once. The faster you can grow that cash, the better the policy can perform and get you better returns in your real estate faster.
Chris, can you take it from the top and maybe just dumb it down on elementary level for people that don't know what this is? Like 5-minute quick snapshot of like, hey, difference between term and whole life, and then how you can overfund the whole to eventually pull the line of credit off of it. And then I'm going to ask you this, but we've been told at some points here, like, hey, you never have to pay that back, right? Once that cash value is stacked up. And so that's a nuance within, but start us at the top and I'll ask you some questions along the way.
Yeah, you bet. So, term insurance is just death insurance, right? You pay a premium. As long as you pay that premium and you happen to die while you're paying that premium, you get covered, or your family gets covered. You don't get paid squat. You're dead, right? But you get covered. It's just simple insurance. That's the easy stuff that everybody gets. Whole life is a little bit different. It has a death benefit, but it also has this tax-free savings account that they call as cash value, right? So it's this tax-free, I call it tax-free supercharged savings account because it's tax-free, but it also pays you more than 0.0% at the bank. Like I said, I'll pay you usually at least 5 or 6% a year. Well, that money is in there. Now, what usually happens with whole life, like I said, it's more expensive up front, but then it gets cheaper over time. You'll pay usually in the first 2 or 3 years, almost all your insurance costs in that policy. After that point, almost every dollar you're paying in goes right to this cash account, this tax-free savings account. That is the account you can use as leverage. You can get a line of credit against it from the insurance company or from a bank even, and then use that money to go and invest wherever you want. So the money's still there earning interest, but you can actually get a line of credit from the insurance company to then go and invest it wherever you want. So that's the big key distinction that makes this special, right?
So with this, let's just say, for example, you have a policy and you've had it for a couple of years and you stack it up to $100,000, right?
Sure.
And you want to now then transition to taking the line of credit off it. When you take the line of credit, how does it work? Does the $100,000, like if you keep deploying extra cash into that, and does the $100,000 keep stacking up? And are you paying yourself back to the loan? Like that's the tricky part that I'm having.
That's one of the lies that are taught out there. Yeah.
Yeah.
So let's talk about that. Cause let's say you have $100,000 and you want to use 50,000 of it to invest, right? Well, when you can withdraw the 50,000 out of the account, just like a savings account, you can do that. But what happens when you withdraw money from an account? You now are no longer earning interest, right? So even if you had 100,000, you pull out 90,000, now you're making like piddly in interest. So the other option is you go to the insurance company, or you could go to a bank, either one. But right now, insurance companies are cheaper interest rate wise. Go to the insurance company and you can go to them and there's no process. There's no like underwriting. You have to go through like a mortgage, trying to get a home equity line of credit. They'll just give it to you. It's already there. They'll let you get access up to 95% of that money. So if you got $100,000 in there, you want to take out, say you want to borrow 50,000 from them, even though they'll let you borrow 95, you take out 50,000, that money's still there earning tax-free interest, right? It's still earning interest. The 100,000 is all there. Even though you use 50,000, you're using the insurance company's money. Here's where the lie comes in that you hear all the time, right? By infinite bankers. And they only do this because the way they set up their policies aren't sexy enough. So they have to lie to you about it to make it enticing, right? And then they'll say you pay yourself back. That's bull. The insurance company does charge you interest. They do charge you interest. And sometimes it's even higher than what you're earning. However, here's the key thing is that if, let's say you take that 50,000, you put into an investment that pays you $500 a month, right? So it's paying you 1% a month on it. Well, instead of what you do is you take that $500 a month, use that to pay towards that line of credit. Well, when you do that, you start paying the loan balance down. That means you get less and less charged to interest because now less is being charged to you, right? So you're being charged every month. Here's the good news though, with that loan. As you start to pay it down, less and less gets charged to you in interest while your money is compounding. So it's like a reverse curve, right? One exponentially compounds, the other one's simple interest. They're not the same. So you can actually still win. Here's the cool thing though. To pay it back though, even though I'm saying use that $500 a month to pay it back, you don't have to. You can pay back those loans, however, whenever you want. Your deadline for paying it back is your death. That's the key. There's a balloon payment due at your death. So, when you die, what they do is they just take it from the death benefit and then pay the rest of your family tax-free. So let's just say that 50,000 was a loan, but that was $1 million, policy that you have there. If there's still a $50,000 loan out, they'll take out their 50,000, pay off their loan, pay your family the other 950,000. So you get that back. But again, that's the difference.
That's the beauty of it. Thank you. You explained it better than anyone we've had on the show. And also a couple of people that I've talked to about it, they do kind of blur the gray area there. But my real question came at the end where it comes off the death benefit and, it's the $950,000. Say you had $1 million, right? That 50 goes back, pays them. Then your parent, whoever, outlives you essentially gets that 950,000. My question here goes to the percentage, right? That you said it's due at your death, at your time. So in theory, you can make an interest payment on that every month. You don't have to ever pay it down, really, right? Do you have to make a payment, or can you just say, you don't have to? You literally just. What's the point of not making a payment then? Like, where's the negative? What's the positive? My thought is, okay, why would I ever pay anything towards it? If I take $100,000 and I use all of it, why am I going to pay any of this interest back? I'll just let them pull it off on my death. Who cares?
Yeah, that's where the infinite bankers, they realize that they're going to lose in a debate that way, because the money will come. There's interest always being charged, right, on that money that you borrowed, just like at the same time you're earning interest. But like I said, if the loan rate's even like a slight fraction of percent higher, it'll compound a little bit faster than the money that's in there. And so you actually will lose to interest if you never pay it back. So that's why they always say, pay yourself back, quote unquote, right? Because you're not really paying yourself back. You're paying down the line of credit so that less and less interest is being charged while your money's compounding, and it'll cover more than the cost. You'll still net gain. That's the distinction there. But here's what I think is awesome. Because like I said, if you're someone who's a flipper, right? And you got 6 to 12 months, you don't have to make interest payments. You don't have to do any payments for that matter. They will still charge you interest. Just be aware of that. They will charge you interest, but you're not required to make any monthly payments. So you can go and do your full transaction, sell the property, pay it down or pay it off, do whatever you want, or pay nothing at all. I did have a client that they did that. Like they were partnering. It was a mother, son. They were partnering in a deal, $125,000 they borrowed from their policy to put on a deal. A year later, they sold the property, made $30,000 profit. So they had $155,000 back in their pocket. They said, okay, Chris, do we pay back this loan on the life insurance or do we invest it? I said, well, do you already know where you're going to invest it? Yeah, we already know the next deal. I said, well, you can just invest it if you want. You can just not pay the loan if you don't want to, or if it makes you feel a little bit more easy because you kept the interest rate down, just pay the $6,000 of interest you got charged last year, and then take the other $150,000 and invest that. So there's that flexibility. You can do whatever you want depending on what makes sense in that situation. You can even play the interest rate game. Like just a couple of years ago, early 2022, I was only paying 3% on my loans with the bank. There was a specific bank, certain banks that specialize in these loans. They were charging me prime rate or even below, like they bottom out at 3%. So I was paying 3% while they were paying me almost 6%. I was making huge amounts of arbitrage there in that scenario.
Yeah.
So there's cool different ways you can use it. But that's the thing is that if it's not something you're going to learn overnight and don't expect to, but just know that if you can get a policy set up where you get the max ROI possible, right, on the cash that's in there, that just gives you more cash to play with and invest with. And that's what creates this thing. And I tell people all the time, you will never become financially free if you're trying to get away from the 9 to 5, this won't make you financially free by itself. In fact, I tell people all the time, this tool by itself doesn't do jack squat hardly. I mean, it's a cool little savings account. It's guaranteed and all that good stuff, but it's not sexy. It's not going to make you rich. What will make you rich is when you do real estate investing, you do that, but you couple this tool with the real estate investing and you just throw a little extra gasoline on the fire to make it happen a little faster. What might take you 10 years to get to your financial freedom number might be able to be accomplished in 9 years instead, just by using this strategy.
It's great. Last one on this. So for example, that 100K that you have in the cash value, say you did take the loan on that and you use all the 100K. Are you then, you're done with the cash value, right? You have to pay that back to be able to use it. Is that the shtick here?
Exactly. Yeah. Now, if you're still paying premiums, because you never want to do this like a one-time dump in because that'll cost you too much. You'll lose to insurance costs if you do that. Yep. But the next year pay the premium, there might be more to pull out. And especially because we try to get to the net gain as quick as possible, usually by year 3 or 4. So say that's even after 4 years, you throw in like, say, another 25 grand or whatever, right? Well, cool. Well, if that 25 grand goes right in there, you might still have access to like 20 some odd grand you can pull right out the next day, So, and some people, if I call it the worst case scenario. Worst case scenario is the nice thing is when you design it, you can create a window, right? Like say that your max you want to put in is 25,000 a year. Your minimum might only be about 4,000 or 5,000 a year that you're actually required to put in. So you have a range. So even if you can't do 25, at least you can do something less, and then you can do catch-up contributions later, right?
Yeah,
but
I think it's the way that these are set up in the beginning, because I have a couple different policies, and for me, it sounds sexy to me, and I go through it, right? But it is kind of hard to understand unless you look in the beginning. It has to be set up properly. There's like paid up riders, and I'm like, okay, well, I just transitioned over to paying in full at the beginning of the year because it's awesome. Then the cash value is immediately there. I'm like, dude, why would I not do this? Have this start stacking? And it's hefty. It's a big sum. I hated the monthly payments, to be honest. Like it was getting very pricey. And I was like,
well, and you get charged more. Yeah.
For the
monthly payments cost you more because just like any kind of insurance, right? With monthly, if you pay annually, you save a little bit paying annually versus monthly. Same thing in life insurance, but it's amped up. And that's one thing that pisses me off too. Like I would say 90+% of our clients will pay annually because we want more going into the cash, not going to the insurance costs. Because that's what the agent gets paid off of is the insurance costs. I want as little going to those costs as possible so that you make as much as possible.
Can you, sorry, I have so many questions on this, but can you make alterations to plans? Like for example, like say I had one set up with a specific company, right? And you come in and you say, right, like, this isn't optimal. What do you do in that case? How do you pivot? Do I shut one down? Can you move the cash value? Like what's the nuances in there to correct your wrongs? Because as you mentioned, some people here may have listened to some other show or they have an advisor telling them to do this and they might have them set up improperly. I'm sure you have clients or some people that come to you with this.
Oh, all the time. Yeah. We get a lot of people that ask for apples to apples comparisons, And so, one of a few things can happen. One might be, especially if you've had it for several years, it might just, one, in a very rare case, we've only in like less than 1% of cases that people will match our numbers. Usually it's not that way. But if you've had it for a while, there might be times we might say, well, you could do a tax-free transfer of the money. Just like, in real estate, you have the 1031 exchange. Well, here there's like a 1035 exchange, which is a tax-free transfer of the cash over to a new policy. But we never want to do that unless it puts you in a better position. If not, we'll just say, kind of like what you said, you know what, it's not optimal, but you're kind of past the heavy fee period already. You're probably just better to keep it, even though maybe in 20 years it might catch up or beat it using our plan instead. But in many cases, especially if it's newer, we'll see this policy and say, okay, that sucks. We can move it over. We can move over that tax-free transfer if it makes sense to move it over. Sometimes it doesn't. and then do a new policy, make sure it's set up the right way.
And is there, last one for me on this is, as I think about this all the time, say your lifestyle changes or something happens and you can't afford the plan anymore, right? Like, for example, like I know personally they're expensive, but I've been able to weave this into my plan and I forecasted it. But there's other people that, you know, life hits you and you might be like, do you lose all the benefit? Like say I had $100,000 saved up in this cash value account for this and I can't pay anymore. Do you lose that cash value or can you use that to pay the premiums?
Yeah, you don't want to end up like me back in when I got my policy, right? And then all of a sudden there's no cash in it and then I lose it after paying $25,000. The way we set it up, it's really hard to break it. And I've had only a few people do it out of like hundreds and hundreds of clients. The only time it ever happens is if you say you put in the first year, you put in the money, took out the max loan you could possibly take out, and then you put in nothing more after that. Then if that's the case, you're probably going to lose it. But here's the thing is that, remember I mentioned like if you have a max set at 25,000, by the way, we never worry about the death benefit. We always just figure out what's the max you want to be able to contribute and we reverse engineer it to be the minimum death benefit needed to allow that to do it, to be the case, right? Well, in like a certain situation, I had somebody come to me, they're like, hey, I just got laid off from my job. It sucked. Or I've had a lot of real estate investors say, man, like I've had to pivot my company. I laid off 3/4 of my workforce. What are my options here? Well, I said, one, you could pay the minimum. So if the max was 25,000, you really only have to pay $4,000 or $5,000 a year for this year. Well, what if I don't have the 4,000 or 5,000? Well, did you leave at least that much in cash inside the policy? Yeah, I did. Then you're good. We'll just borrow from the policy to pay your premium, which is kind of like taking money out of your savings to put it back into savings again, right? You know, it doesn't sound like it makes sense, but at least keeps it going. It keeps it working. I was like, you can always pay the loan later if you want, or pay more later. And so the way we set them up, usually they won't blow up or implode. It's pretty rare that ever happens. Like you'd have to like intentionally almost destroy it to make that happen.
That's good.
Yeah, makes sense. So, I mean, Chris, anytime we can get tidbits of information like this, even if it is just a strategy to help get people more liquid, that's one of the things we love to do in our show. It can really, we've had 2 or 3, you're maybe the third person we've had on, or maybe fourth, about infinite banking. I've never taken the plunge. I feel like my head's filled enough, but it seems like a way to get more liquid versus stacking up in some of the accounts that I have to sell in order to access, where if the goal is to invest in real estate anyway, why would you not want to have it more accessible? So for people that want to get to know more about you and what you do, maybe learn from you, I know you have a book, Beyond Rice and Beans, 7 Secrets to Free Up Cash Today. That sounds like a lot of the strategies that we were talking about in this episode. But what's the best way for people to get in touch with you? You know, moneyripples.com is your website. Like, how do you foresee helping people? Hopefully there's people from the show that want to tune in and listen to what you got.
Yeah, you go to moneyripples.com. Obviously, like you mentioned, we have our Money Ripples podcast on YouTube or iTunes, wherever you listen to podcasts. And heck, even our YouTube channel, on our Money Ripples channel, I mean, there's even like master classes we've recorded on this very topic where we would go in depth and show you how that infinite banking works, or what are different strategies you can use to create passive income. Like what are the different options within real estate? Because there's so many that you can do, right? So we have all kinds of classes and free information on that.
Cool. Chris has, I'm reading this here, but it's an important stat. Your clients have increased their cash flow by almost 300 million in the last 12 years. So I know that's not, that's a lot of money. There's a lot of clients who have done this. So if you're looking to kind of find new ways to not only create the cash flow, but have the access to the liquid cash to go deploy, Chris has a pretty cool program. So check him out at moneyripples.com. Anything else for you, Ryan?
No, Chris, it was a pleasure having you on the show, man. Thanks for joining us. Candidly, I love the topic of infinite banking. It's just been one of my favorite to dive into, and I think you delivered very succinctly. And thanks for answering all my questions. Really appreciate it, man.
I appreciate that. Thank you.
Thanks for tuning in this week to the Weekly Juice Podcast. If you liked what you heard, please leave us a 5-star review on Apple Podcasts, subscribe, and share with friends. The more ratings we get, the more ears we'll get on our show, and in turn, we'll be able to provide you with more high-quality guests. You can also find us on Instagram at Weekly Juice Pod, where we post daily tips and tricks and document our own journey towards financial freedom. Make sure to tune in every Wednesday to get your weekly juice.